In this video, we'll look at how we account for depreciation of non-current assets. A non-current asset is a present economic resource. It provides economic benefits to the entity and it is controlled by the entity. It is not held for resale and it is expected to be used for more than 12 months. A depreciable asset is a type of non-current asset which has a finite life and it will be depreciated over its life. Finite life means that there is a limited life to the asset. A non-current asset is like a glass of Milo. When we first buy a brand new equipment at a certain purchase price, it's like this full glass of Milo. The purchase price is called historical cost. It's a glass at full value waiting to be consumed to provide some sort of benefit. Useful life is the estimated time that the non-current asset is used to generate revenue. While an equipment might have a useful life of about 5 years to generate a revenue or a benefit for the business, this Milo, on the other hand, might just have a useful life of about 5 minutes. As we use the equipment over time, we are consuming the asset's value, like this. This is called depreciation. At the end of the useful life, and in this case 5 minutes, there might be still a little bit of value left over. In other words, there's still a little bit of benefit left that we can consume from this asset. This is called residue value. Darling, do you want my leftover Milo? A car is an example of a depreciable asset. Let's assume that this car has a useful life of 5 years. In other words, we are expecting that this car will be used within the 5 years to earn revenue for the business. Assuming we bought the car for $20,000 plus GST, this would therefore be the historical cost, which is the purchase price. At the end of the 5 years, we are estimating that there will be a residue value of $5,000. So over the years, we would have depreciated the car by $15,000. In a way, we are allocating the value of the non-current asset consumed over its useful life totaling to $15,000. The first depreciation method that we'll be looking at is the straight line method. It is typically used for non-current assets that contribute evenly to the revenue and when the value of the non-current assets is incurred evenly over its life. For example, fixtures and fittings and office furniture. Whether the table is used on the first day or after 5 years, it still has the same contribution to the generation of revenue. So let's calculate the depreciation using the example of our car that we've purchased for $20,000 and has an estimated residual value of $5,000 at the end of 5 years. The depreciation over the 5 years would be $15,000, while the depreciation expense per year works out to be $3,000. And to calculate this, we take the $15,000 depreciation divided by the useful life of 5 years to give us a $3,000 depreciation expense per year. So here we can see that we are depreciating the car by $3,000 every year evenly. If you prefer, this is the formula that we use to calculate the depreciation expense. So at the end of the first year, we can also calculate the carrying value of the asset. And we do this by taking the amount of $20,000 less the depreciation of $3,000 for the year to give us a carrying value of $17,000 after the first year. The carrying value is basically the value of the non-current asset that is yet to be incurred or allocated as expense. Using the amounts that we have calculated earlier, we can also calculate the depreciation rate using this formula here given. And this gives us a depreciation rate of 15% per annum. You might also be asked to calculate a depreciation expense using a rate that's been given. So in this example here, we've purchased shop fittings on the 1st of July 2024 at a purchase price of $9,000 plus GST. The depreciation rate given to you is 15% per annum, and the balance day where we are closing the accounts is the 30th of June 2025. The depreciation expense works out to be $9,000 times 15%, which is $1,350 depreciation per annum. However, we need to be very careful if we are depreciating an asset that was purchased mid-year. In this example here, we have purchased shop fittings on the 1st of March at a purchase price of $9,000 plus GST. The depreciation rate given to us is 15% per annum, and the balance date is 30th of June. So note here that we have only used the asset for 4 months. In other words, we can only calculate the depreciation expense for the 4 months that we have owned the asset. To do this, we take the $9,000 multiplied by the 15% depreciation rate per annum. But because it was only used for 4 months, we need to multiply it by a fraction of 4 over 12, which is 4 months over 12 months. This gives us a depreciation expense of $450 that we can record for the year. Using the example from the slide before, this is how we record the depreciation in the general journal account. We debit the depreciation of shop fittings account, which is an expense, and we credit the accumulated depreciation of shop fittings account, which is a negative asset. Then we post the transactions in the general ledger similarly, where we debit the depreciation expense and we credit the accumulated depreciation account. Now, because the depreciation of shop fittings is an expense account, therefore we would be closing this account to the profit and loss summary account. Whereas on the other hand, the accumulated depreciation of shop fittings is a negative asset, we would therefore be balancing this account. When we are reporting depreciation in the financial reports, we will be reporting the depreciation expense in the income statement under the other expenses section, whereas in the balance sheet, we will be reporting the accumulated depreciation amount under the non-current asset. The next depreciation method that we'll be looking at is the reducing balance method. It is typically used for non-current assets that don't contribute evenly to revenue. When it's new and productive at the start, the non-current asset contributes more to the revenue. Therefore, the asset's value is consumed more at the start. For example, equipment, machinery, and car would fall under this category. When we are asked to calculate the depreciation using the reducing balance method, we will be given the depreciation rate. In this example here, we purchased the car on the 1st of July at a purchase price of $20,000 plus GST. The depreciation rate given to us is 15% per annum, and the balance date is 30th of June. So here we are at the start with the purchase price of $20,000. We calculate the depreciation expense for the first year by applying the 15% depreciation rate to the $20,000, giving us a $3,000 depreciation expense. At the end of the first year, we need to calculate the carrying value of the car, which works out to be $17,000. Then we calculate the depreciation expense for the next year by taking the 15% multiplied by the carrying value of $17,000. This gives us a depreciation expense of $2,550. Again, we work out the new carrying value, and the depreciation expense for the next year would be 15% on the new carrying value of $14,450. And we do this continuously. This is the formula given to us when we are calculating the depreciation expense using the reducing balance method, where we take the depreciation rate percentage multiplied by the carrying value. Note that the recording and reporting of the depreciation is the same as how you would record and report for straight line depreciation. Now this is the end of calculating the depreciation. Thanks for watching.